Hello students, welcome. This is Ms. Mercado speaking once again. Today I am going to briefly go over some of the important information or key information from chapter 13, which deals with accounting for merchandise inventory. Okay, this is accounting 1303, Introduction to Accounting 1, and we are using the textbook College Accounting 23rd edition. Now make sure that, like always, I stress the importance of reading. Reading the chapter before you begin working on your assignments is very important. There's PowerPoints posted on Blackboard, which I highly recommend that you download or you print them out and you take notes as you're reading. That way you're able to analyze and sort out the information better. Okay? And that way when you're working on your assignments, you're more organized. You've already covered the content, not only when you've read it, but when you've reviewed the PowerPoint presentation. Okay? So this lecture does not substitute you reading the chapter. You must read on your own. That's your assignment here. Part of your assignment is to read. Okay? So I am just going to highlight some key information from the chapter, and then I am going to work out one of the problems that you're going to be seeing on your homework. That way you can have some kind of guidance as to how to complete it. Okay? So I'm going to go ahead and I'm going to get started with our learning objective number 1 in this chapter, which is explaining the impact of merchandise inventory on the financial statements. Okay, so we are introduced, or we utilize this account called merchandise inventory. Okay, merchandise inventory is an asset account. Okay, we own that inventory. So let's say, for example, that you are selling, what can you be selling? Furniture. Okay, so let's say, for example, you are selling furniture. You purchase furniture from a wholesaler. You put it in your warehouse. All of that furniture that's in your warehouse that you have not sold, that is your merchandise inventory. You own it. It's yours. That makes it an asset, current asset, because you should be selling it within a year. Okay, you don't want to have too much inventory because you're going to be holding up or not using the assets appropriately. So it's very important that you only purchase the inventory that you require or that you need. You don't want to have too much inventory because it may get damaged, it may get stolen, it may get obsolete, where new model of furniture comes out. So you want to keep just the correct amount or an appropriate amount of inventory. So when we're dealing with inventory, we have several factors. Okay, the cost of goods sold available for sale during the accounting period needs to be divided between the cost of goods sold and the ending merchandise inventory. So we have an account and we need to figure out how much of that cost of goods sold is how much you pay for your goods. Okay, so let's say, for example, you buy a dining room table. Okay, that dining room table costs you $500. Okay, so then you have to record that when you purchase the dining room table. Then when you sell it, you're going to be selling it at a higher price. That's how you make a profit, right? You're going to be selling it at a higher price so you can make a profit. So when we're dealing with inventory, we need to identify how much of the goods have been sold, how much of the goods have not been sold, so we can be able to calculate our cost of goods available for sale. Okay? So the cost of goods available for sale during the accounting period must be divided between the two categories, whether it be cost of goods sold or ending merchandise inventory. Cost of goods sold is reported on the income statement. Now, this is how much you spend on the goods, whatever is it that you're selling. Okay, so the cost of goods sold represents how much you're spending on the merchandise that you're buying to resell. Okay, and then we have the unsold portion of your merchandise. Okay, what did you not sell? Well, I still have 5 dining room tables in my warehouse. Whatever you have not sold, that goes into your balance sheet under merchandise inventory. Okay? So it's very important that we understand. Okay, we're going to start off with our beginning inventory, if we have any. So that's any inventory you had left over from the prior period. You're going to add any purchases. Any purchases that were done in the current period. That is going to give you the goods available for sale. Okay, so I have this bucket, which is your goods available for sale. This is what I can sell. Okay, at the end of the period, you have to get your bucket and you have to figure out, okay, how much from the bucket has been sold, how much has not been sold. And we have to categorize it between if it's been sold we need to account for it under cost of goods sold. If it is not sold, then we need to account for it under merchandise inventory. Okay. In this particular chapter, it's another component that's highlighted is the difference, the difference between our two types of merchandise, or how to account for our merchandise inventory. Okay, so we have two main ways of doing it. Okay, so our second learning objective is to describe the two principal systems for accounting for merchandise inventory, and we have the periodic system and the perpetual system. Okay. I've done inventory in the past, and everywhere that I've worked for, we've used the perpetual inventory system. But it just depends on where you work, okay? So here we have the differences in calculation between the two, okay? So we have the periodic inventory system, okay? So in this particular system, when you're accounting for inventory using this method, you're going to go ahead and the purchases account is going to be debited for the cost of all of the goods purchased. So you're going to have an account called purchases, and anything that you spend on purchasing your goods, that's where you're going to debit, okay? And then we're going to have the sales account is going to be credited for the selling price of all goods, okay? So we're going to have whenever you sell it, you're going to record the sales price, okay? And then at the end of the accounting period, you're going to have to get a physical inventory of your inventory. So you're going to have to go to your warehouse, and you're going to actually physically count all of your inventory. And then you're going to use the following formula to be able to calculate all of the different components of your inventory, so you can be able to make the necessary adjustments, okay? So to calculate the cost of goods sold and figure out how much have I sold, so you can be able to figure out how much you should have left. So you have your beginning inventory, which is last year's ending physical count. You're going to add your net purchases. Okay, that's going to give you the cost of goods available for sale. Then you're going to subtract your ending inventory, and that's going to be obtained from the physical count of the inventory that you have. And then that's going to give you the cost of goods sold. It should give you. Now, there might be some discrepancies because there's always goods that are damaged. Sometimes some of the goods get stolen. But you're doing this on an annual basis. Most companies conduct inventory once a year, and that's when they update their accounting records. So we do a physical count of what we have in the warehouse, and then we figure out how much of what we had plus what we purchased plus what we have in the warehouse will result in how much we have actually sold during the year, or the cost of goods sold. Okay. Now, everywhere that I've worked in the past, I've worked for maquiladoras, we've used the perpetual inventory system. Okay. So, in this particular method, the merchandise inventory account is debited for all of the purchases. So we have an account called merchandise inventory. Whenever we make a purchase of the goods, we debit merchandise inventory. Okay. The cost of goods sold account is debited, and the merchandise inventory account is credited every time we have a sale. So what happens here? So every time we have a sale, we adjust our inventory. We decrease our inventory by the amount of the goods that were sold, and we record our expense, which is our cost of goods sold. Okay. So by doing this entry, our merchandise inventory account is updated continuously, and it allows us to provide a running balance of the goods on hand. So at any point in time, we should know fairly closely how much we have in our inventory. Now, even though a lot of the companies that I've worked for did follow the perpetual inventory system, which was we updated our records as we went, they did conduct an actual physical count of the inventory, just so we can confirm, what we have in our books, is it the same as what we have in the warehouse, okay? And then we can adjust for minor discrepancies, either in damaged goods or items that got misplaced or stolen, and then we can make those adjustments. But the amount should be very close, and you should always know how much you have, okay? So, the periodic and the perpetual inventory systems are just different methods to track the quantity of goods on hand. So this is how much inventory do I have right now available to sell? How much goods have I sold? how much have I, what is the amount that I've sold them for? What are my sales? Okay. The more sophisticated of the two systems is the perpetual system, but it does require a lot more record keeping to be able to maintain your balances current. Okay. So every time you make a purchase, you have to record. Every time you make a sale, you have to record. So it requires a lot more work or bookkeeping to be able to keep up with it. Okay. So the periodic system relies on an occasional physical count of the inventory to be able to determine the ending inventory balance and the cost of goods sold, while the perpetual system allows to keep a continual track of the inventory balances. Okay. So there's no right or wrong answer. It's just preference. You know which one you are using. Whichever one you select, you must keep on using. You can't change back and forth. So just make a determination. Okay, I'm going to be using the periodic, or I'm going to be using the perpetual, and then from that point forward, apply the logistics behind it so you can be able to keep track. If you want to know at any point in time how much inventory you have, then the perpetual inventory system would work excellent. Okay. If you have maybe very little inventory, or you don't have the manpower to be able to do all of these record keeping, maybe you want to do the periodic inventory system. That will work fine. Like I said, they're both approved. You can utilize them. It's just a matter of preference of what works best for your business. Okay. So now I'm going to run over to our learning objective 3, which is, I guess, the fundamentals of this chapter. The information, they provide a lot of information, but at the end, we are interested in computing the cost allocated to our ending inventory and cost of goods sold using different inventory methods. So what does this mean? We want to figure out how much our inventory is valued using the 4 methods that are provided. Okay. So there's 4 inventory methods that are commonly used to determine the cost assigned to the goods sold and the ending inventory. Depending on what type of inventory you have is the type of method that you're going to use. Okay. So we have specific identification, FIFO, which stands for first in, first out, weighted average, and LIFO, last in, first out. Okay. The actual physical flow of the inventory does not have to match the method used. During periods of when prices rise, LIFO produces the lowest net income. Okay. Why would we want to produce the lowest net income? Well, because you have less income, you pay less taxes. Okay. While FIFO produces the highest net income. Okay. So it just depends. And just like the method of accounting for inventory, once you select it, that's the method that you have to use going from that point forward. You can't be switching back and forth. Okay, you're going to say, this is the type of business I have. I have selected this type of valuation for my inventory for this purpose, and this is what I'm going to be doing going forward. Okay, so I'm going to briefly go over the 4 main inventory methods that are used. The first one we have is specific identification method. Okay, and just like the title says, specific identification is used when the inventory that you have can be specifically identified, meaning it's a unique product that you have. So to use this method, the inventory items need to be different from one another, or they must have some form of serial number or code that can distinguish each of the items separately. Some examples of this include cars, appliances, and fine jewelry. Okay, so if it's something that you can specifically identify, you have you might have 20 Nissan Sentras, but each Nissan Sentra has a specific serial number assigned to it, a VIN number. It could be a VIN number. Maybe you're selling diamonds. Okay, every diamond has a certificate, and each certificate has its own certificate number, identifying the type of diamond, the type of ring, or whatever the case might be. So they're unique items. Okay, so if you have a unique product, then you can use specific identification. Okay, we also have FIFO, which stands for first in, first out. So what does that mean? The first items that you purchase are the first items that you're selling. That's what it means. So this is a costing method that assumes that the first goods purchased are going to be the first goods sold. So you're always going to be selling your oldest merchandise first, okay? So that means that you're always going to have in your warehouse the newest purchased inventory. Okay? Whatever you purchased last is what you should have in your inventory, okay? Some examples of companies that use the FIFO method include grocery stores, fresh fruit stands, or computer software. Basically, anything that is perishable, you want to sell the oldest. You don't want to keep keep the old and sell the new. No. Let's say, for example, you have bananas. You order crates and crates of bananas. Okay? Are you going to sell the new bananas or are you going to sell the old bananas? Well, you want to sell the old bananas first because they're going to rot. They're going to spoil. So you want to make sure that you're selling your oldest merchandise first. Computer software or maybe cell phones, okay? Nowadays, they come up with a brand new cell phone every 3 to 6 months, okay? You want to make sure that you're always selling your oldest merchandise, okay? You get the new merchandise in, well, what happens to your old merchandise? It loses value, okay? So this is good for when an item is either perishable or it runs the risk of becoming obsolete, okay? The next one we have is the weighted average method, okay? And this is the costing method used based on the average cost of, and the key word here is identical units. Okay? You must be selling the same exact product to be able to use the weighted average method. Okay? So let's say, for example, you have a Ford Mustang, a Chevy Camaro, and a Corvette. They're not the same type of car. They're different cars with different costs. You cannot use the weighted average method because they're different. They're not identical units. Okay? So, you must have identical units to be able to use the weighted average method. To be able to calculate your weighted average method, you're going to get the cost of the units available for sale, and you're going to divide by the units available for sale to get your average cost per unit. Once you get your average cost per unit, you just multiply it by the number of units that you're selling, and that will give you your cost, your average weighted average cost. And last but not least, we have the LIFO method, which is the last in, first out. Okay? This is a method which assumes that the sales in the period were made from the most recently purchased goods. So the last items in are the first items out. So you're going to be selling your newest inventory. Okay? The earliest goods purchased or the oldest items are going to be the ones that you're going to keep in your inventory. Okay? This is good for non-perishable items or items that are not likely to become obsolete. An example is a barrel of nails. Okay, we have a barrel of nails. A nail will be the same today, tomorrow, in 10 years. Okay, nails have not developed to be sophisticated. They're the same thing. Okay, a hammer, the same thing. You know, a hammer will always be a hammer. Okay. If it doesn't really matter, it's not tied to technology, it's not tied to a perishable item. It doesn't matter because they're identical items, whether you manufacture them today or tomorrow, you're going to be purchasing the same product. Then you can use the last in, first out. Because it doesn't matter if you sell the new or you sell the old, it's the same product. Okay? And here, for convenience purposes, they're selling the items that came in last, they're selling those first. So we're going to apply these concepts to a particular problem, okay? Just remember, there's two main inventory methods. We've gone over each of them. Now, the example that I am going to run over or go over with you deals with inventory using two of the methods that I just spoke about. And we're also going to be determining the lower of cost or market, okay? So the problem that I'm going to be covering is exercise 13.5, lower of cost or market. So it says, calculate the total amount to be assigned to the ending inventory of Stellberg's company's beginning inventory and purchases during the fiscal year ended December 31st. And then they give us the information. Okay. So we have on January 1st our beginning inventory. We have 10 units at $20 a piece. That's a cost of $20. On March the 5th, we made a purchase, our first purchase. We bought 10 more units at $22. That's $220. On September the 9th, we made another purchase. We made our second purchase. We purchased 10 more units at $25 each for a cost of $250. So if you notice, the unit price is increasing. Okay? And then finally, on December the 8th, we made our third purchase. We bought 10 more units at $30. That's $300. So now I have 40 units, and the total cost of those 40 units is $970. Okay? Now, they're telling you that there are 10 units of inventory on hand December the 31st. Okay? So there are 10 units on hand. You know what? And I was going to do the solution in another sheet of paper, or another tab. I'll just do the solutions here. That way we can see it as we're using this information. So, it says here, there are 10 units of inventory on hand December the 31st. Requirement 1. Calculate the total amount to be assigned to the ending inventory under each of the following periodic inventory methods: FIFO and weighted average. Okay? So, first I'm going to do FIFO. Okay, so I'm going to do letter A. Okay? So under letter A, they're asking us for the ending inventory. Inventory under FIFO. Okay? So, FIFO. First in, first out. So what does that mean? The first one's in are the first one's out. So that means that I'm going to be selling my oldest merchandise. Okay? I sell my oldest, I keep my newest. Okay? So, if you're selling your oldest and keeping your newest, it says here that you have 10 units of inventory on hand, then which units are you going to keep? Okay? And this is where we have to think. Well, FIFO says the first ones in are the first ones out. So it means I'm going to sell my oldest and I'm going to keep my newest. So if I have 10 units left, which 10 units am I keeping? Well, I'm keeping the newest 10 units. Okay? So so that means I am keeping those 10 units right there. I am keeping 10 units at $30 each, and that's going to be $300. Okay, so my ending inventory under FIFO is going to be $300. So that means that I sold 30 units and I kept 10. And these are the 10 that I kept. I kept the 10 newest units. Okay? Now letter B. Letter B is ending inventory under the weighted average. Now for that one, we're going to get our cost of units available for sale, and we're going to divide by the units available for sale to give us our average cost per unit. Okay, so by doing that, the cost of the units available for sale, my cost is $970. So that's going to be $970. I'm going to divide it by my units available for sale. I have 40 units. Okay. So now let me get my calculator out. Okay. So I have 970 divided by 40 units. So each unit is going to be worth $24.25. Okay. So now that I've calculated my weighted average cost, now I know that I have 10 units remaining, because that's what the problem says. The problem says that you have 10 units on hand. So I have 10 units. I am going to multiply it by the 24.25 that we calculated, and then that's going to give me 10 times 24.25, $242.50. That is letter B. Okay. Let me cut this and paste it a little bit to the below that. Okay. And do it a little bit more. Cut. Paste. Sorry. So I'm gonna cut this and I'm just gonna move it down. Okay. So that's the first requirement right here. Okay. So we have letter A and letter B. Now, this is requirement 1. Now for requirement 2, they're asking, okay, assume that the market price per unit, this is the cost to replace of Stahlberg's inventory on December the 31st, is $26. Okay? So we have to calculate the amount to be assigned to the ending inventory on December the 31st under each of the following methods: the FIFO and the weighted average. So we have to assume that the market price right now of these goods is $26. Okay? So if I'm going to go out there and I'm going to purchase these goods, I'm going to purchase them for $26. Okay? That's the cost to replace these goods. Okay, so if I need to get more, that's how much I need to pay up, 26 bucks. Now, we have to calculate the amount to be assigned to the ending inventory using each of the methods. Okay, so requirement 2. Okay. So, letter A for requirement 2. It says, the first one we have to do is either FIFO, lower of cost, or market. Okay, so we have to compare our FIFO cost and our market. Okay, so my FIFO cost is going to be what I calculated up here. My FIFO cost me 10 or my ending inventory for that inventory that I have is 10 units at $30. That's $300. So that's my cost right now. That is how much my inventory is worth under my account ending inventory. Under my merchandise inventory account, I have 10 goods valued at $30 each. So I have my inventory at $300. Okay. Now according to the market, they're only worth $26. So I have 10 units times $26. Okay. This is market. Let me move this over a little bit here so that way we can get more space. So that's 300. So 10 times 26, that should be 260. 10 times 26, that's $260. Okay. So according to my FIFO cost method, my inventory is valued at $300. Okay. According to my market, my inventory should be valued at $260. Okay. So it asks you here, assume that the market price of the inventory is $26. Calculate the total amount to be assigned to the ending inventory under each of the following methods. So once you have your FIFO cost, which we calculated in requirement 1, you're going to compare it to your market price, which is the 10 units at $26. You have to choose which one is the lowest. Okay, the lower of the cost or market. Okay, so I am going to choose the market because it is lower. Okay, so you have to compare your cost versus your market, and whichever one is the lowest, that's the one that you're going to choose. So I'm choosing market for that one, for letter A. Okay, for letter B, we have the weighted average. Lower of cost or market. Okay, so under this particular, under the weighted average, my weighted average cost that we calculated in requirement 1 was $242.50. Okay, so that's the amount that we have, $242.50. Now I'm gonna do the market. Okay, and the market was 10 units at $26 each. That's gonna give me $260. So now you have to compare the weighted average cost or the market cost. Which one is lower? Well, the lower one in this particular, and I misspelled weighted. Let me fix that. So it's weighted. I'm sorry. I put on nails and I cannot type. Okay, weighted average cost. Okay. So you compare your weighted average cost of $242.50 to the market, which is $260, and you choose the lowest of the two. In this case, I am going to choose the weighted average cost, okay, because it's the lowest of the two. Okay, so you compare your cost with your market and you choose the lowest of the two. In this case, we chose market because it was lower than cost. In this letter B, we chose the weighted average cost because it yielded the smaller amount. Okay, so that is requirement A and B for part 2. Okay. Now, part 3. What journal entry would be made under the cost or market for parts 2A, which is parts 2A, and parts 2B above? So, do we have to make any entries? Okay, and if so, what are the entries? Well, let's look at the first one right here. So, we have our cost of $300 and we have our market at $260. Okay, so in my books, I have this inventory valued at $300, yet I need to update that because it's actually only worth $260 according to the market. So, I am overstating my merchandise inventory. Okay, I'm recording it at a higher amount. I'm recording it at $300. Instead, it should be valued around $260. Okay, so we have to make an adjusting entry. I'm going to do the entry down here. So, I'm going to go ahead for letter A. Let me put here requirement 3. So, the account that I have, this is for letter A, because my cost is greater than my market, I need to bring down my cost down to the market value. So I need to write off the $40 difference. Okay? So, I'm going to have a loss on write down of inventory. And this is going to be the debit. This is going to be the credit. So I have a loss on the write down of inventory, and this is for $40. Okay, so my loss is calculated by the 300 minus the 260. So that's a $40 loss. Okay, so my inventory is valued at 300. I should be valuing it at 260. I'm gonna lose $40 that I have it worth right now. I have to decrease it by $40 to make it go from 300 to 260. Okay, so that's the first transaction or your debit. Now we're going to update our merchandise inventory because we want it to reflect the correct amount. And the correct amount that we should have in our inventory is $260. So we are making the adjustment for that. Okay? So you're going to compare your cost to your market. And in this case, we need to make an adjustment because your cost is greater than your market. Okay? So we're going to make adjustment because the cost, the FIFO cost, reported in our financial statements is being overstated. Okay? So we have to make the adjustment because the FIFO cost reported in our financial statements is being overstated. So I have my inventory valued at 300 when it should be 260. So I need to bring that 300 balance down to 260. That is why we have to make this entry. Now, for my weighted average, okay? My weighted average cost is $242.50. My market is $260. Because my weighted average cost was lower than my market, I don't have to make any adjustments because I already have it recorded at the lower cost, which is my weighted average cost. So you always have to keep the lowest just for accounting purposes. You want to be conservative, so we always use the lowest cost. So in this case, my lowest cost is using the weighted average cost. The market does not, in comparison to the market, it's lower. So because I am keeping or I'm choosing the weighted average cost, I do not have to do any entries here. Entries are only needed if you need to bring down the balance. In this case, in letter B, I don't need to bring it down because my inventory is already valued at the lower of the cost or market. So for B, there is no entry needed. So these are the journal entries that would have to be recorded based on requirement number 2. Okay? And remember, you only make an entry if you need to bring down your balance. Okay? So that is it for this short video or this short lecture. Please attempt your homework. If you have any questions, do not hesitate to reach out to me. Thank you.